And that's why we see some of the volatility that we're seeing, because it just puts a little more uncertainty in the market that certainly we don't need right now.
Especially the government shutdown, because the biggest thing with that is having to figure out the healthcare situation.
All of them want your health insurance premium.
Is this going to be the pickle in January?
Welcome to the Wise Money Guys radio show. I'm your co-host again, John Scambray, and I'm here with my partner,
Giuseppe Visconti.
And we are certified portfolio managers that specialize in helping people who are retired or about to retire manage their money. As always, if you like our show and have any questions or want to arrange a no obligation consultation, which we highly suggest you do, especially before the year is over, or at least early on in the new year, give us a call at 916-967-3500. So last week, Giuseppe, I don't know if you tuned into my wonderful show by myself.
I saw a couple shorts on YouTube.
Okay.
So since we hadn't mentioned that, if you want to see us, put a face to the voice, you can search us on YouTube, and our recorded live radio show also hits YouTube. And you can just search us either John Scambray and Giuseppe Visconti or the Wise Money Guys, and we'll pop up, and it'll come up with a whole episode, and then also some shorts,
some snippets,
usually a couple YouTube shorts. So
yep.
Yeah, I did see a couple of them. One of kind of your forecasts of 2026, yep. And then another one I think on tariffs.
Yes,
is that right?
So I think that's what we need to talk about this morning. So just to give you a brief overview of our conversation, and lots of bullet points I see that you have. So you're raring and ready to go. But last week I talked a little bit about things that happened in 2025, like the big, beautiful bill, tariffs, of course, the government shutdown, things of that nature, the budget not being passed, and a continuing resolution just being the solution that keeps kicking the can down the road. I went over briefly some of the tax deductions or tax deduction extensions that were found that are going to kick off in 2026 that haven't been
for this year's
taxes. So, economically, what I
hopefully
thought
some bigger tax refunds come in April, right?
That's what they're projecting. And so we'll continue the conversation now, focusing now that you're back on 2026 and some of the themes of 2026, which I already mentioned. And guess what? Before it even hit the news, I said, look for some of the same from 2025 being some of the headwinds in 2026, which is government shutdown.
Yeah.
Budget.
When is that? Is that January 30th?
Yeah,
deadline?
it's already. And sure enough, literally like the next day after the show, they started saying, oh, well, gosh, now they're talking about a government shutdown again already.
Yeah.
And that's why we see some of the volatility that we're seeing, is because it just puts a little more uncertainty in the market that certainly we don't need right now, with so many other things kind of just on the precipice of either going off a cliff or being absolutely one of the best years, in a long time.
I think overall this isn't as good as last year or the year before as far as returns, but definitely a good year, double-digit return. And I think we'll finish as a double-digit return. We'll probably have a little bit of a Santa. I think Santa will come visit us here later part of the month. But yeah, it's not without any obstacles here in the near future, especially the government shutdown, because the biggest thing with that is having to figure out the healthcare situation.
Yeah, well, some things that just happened, which is really, really big news, is the House passed the healthcare bill that they've been trying to pass for many, many months now, and it was without the ACA, the Affordable Care Act subsidies. Now, please, know what that really means. Subsidies weren't subsidies to American insurance payers. They were subsidies to American insurance companies. So the only thing that the Affordable Care Act subsidies did was make insurance companies' profitability go through the roof, and people's premiums, families' premiums go through the roof, which is the exact opposite. If you're going to pass anything or put something out there, it should be for the benefit of individuals and families and small business, not
bringing the cost
gigantic insurance companies. And over again, we talk about the affordability of healthcare. That's a total, wash job or con job, because healthcare is not the conversation. Everybody has healthcare. Everybody can go to a hospital and get healthcare, whether you're a citizen or not.
Whether you have insurance or not.
Exactly. All this has been about was big bribes to insurance companies, who then turned around and made huge kickbacks to the coffers of the Democratic, Party and their foundations and their their pet projects.
Also,
and
pharma's correlated with that too.
And so the two big things that are in this healthcare bill, which is an actual healthcare bill, was reducing prescription drug prices through the favored nation parts of the new healthcare bill, and then getting rid of the Obama the Affordable Care Act subsidy, which again didn't go into the pockets of families or businesses.
It didn't make it more affordable.
It did not make it more affordable. In fact, it made,
even though that's the title of it.
I mean, my premium just went, for just me, is going from $765 a month to $1,208 a month. Yeah. And my health insurance coverages got worse. Right. My deductible is bigger. My overall out of pocket is bigger. Right. And my office visits, everything is more, and the premium went up. What is that?
Is your care better though?
No, went up 60%.
Yeah.
So,
well, that is a huge pain point for individuals, especially who are looking to retire early before they're eligible for age of Medicare, is figuring out, can I retire early? Can I retire at 60 or 62 or whatever, and bridge the gap for the 3 or 5 years until I'm eligible for Medicare and pay the premium, because it's huge. And it's huge for those who are looking to retire earlier before they're eligible for Medicare. It's also huge for people who are wanting to be, have the entrepreneurial spirit and go out there and say, hey, I want to run my own business or be a part of a business or so on and so forth, because it's expensive. I have a family friend who's basically like my cousin, and he's paying.
Everybody's a cousin when you're Italian.
Yeah.
By the way,
forget about it. Forget about it. But he's paying literally over $3,000 a month
for his family,
for a family of 4. He's got 2 little kids. His wife was pregnant at the time, so he got, the higher end coverage, but that's not without a deductible. He still has
a $10,000 annual deductible.
It's lower than that because he got a higher coverage.
Good.
But he's paying, I think, like $3,300 or $3,400 a month. That's net. So you figure that out. That's almost $40,000 a year. That's out of pocket. You have to gross at least $65,000 a year
just
to net the amount to cover your insurance.
And what's crazy. So sad is not a single left side of the aisle, and their far left, voted to reduce your healthcare premiums. All of them want your health insurance premiums.
Is this going to be the pickle in January?
This absolutely going to be, but still keep in mind that this just made it through the House. It has not made it through the Senate yet. And obviously if it hasn't made it through the Senate, right, and then, it's not to the president's desk to sign, but it's a huge step forward. And it's extremely important to rein back in the cost of health insurance. Stop being lied to that this has anything to do with health care. The Affordable Care Act and this new health care bill is a health insurance and reducing the cost of prescription drugs and health insurance. And that is what is something that's gigantic for 2026, because if that is the case, again, now, one of the things that I was mentioning for 2026 is that if consumers or the public has more money in their pocket because they pay less taxes, and now if they pay less insurance, health insurance, and if they pay less for groceries and gas and energy, all that sets us up for is another great market, because that additional
frees up some discretionary income,
gets spent on goods and services, gets spent on investments, savings that will help, increase return on investment, because if more revenue is being generated on goods and services because people have more money to spend, well, then guess what goes up? Stock prices go up.
Well, the whole economy,
right?
Yeah.
Everything.
Consumer spending is about 70% of the economy. So huge. So, and we can dive more into the inflation data that just recently came out this week, and some of the components that have really come down that has helped the pocketbook. And if what you're saying actually unfolds next year, we'll continue on.
And just before we go to break, keep in mind how important it is. One of the major things that we talked about last weekend was having a plan, or updating your plan, or reviewing your portfolio to make sure you're positioned for a good year in the right sort of investments that are what I think will be the sweet spot next year versus what was the sweet spot this year. So give us a call at 916-967-3500. Stay tuned. You're listening to the Wise Money Guys. We'll be right back. To the Wise Money Guys radio show, and I'm your co-host John Scambray. I'm here with my partner Giuseppe Viscani, and let's dive into data. We are a show
from Star Trek.
Data, by the way. So in order to keep talking about 2026, we've got to keep talking about 2025, because inflation will still be a big theme in 2026. Is it under control? Employment will be a big thing in 2026. We've already mentioned that the budget, a potential government shutdown, tax policy, tariff policy, all these things will be a major impact to the returns that you make on your money, to the income you can generate from your money, so on and so forth. So let's kind of dive in a little bit to some of this end of the year data that's come out. And I see
did you mention
2 pages of notes.
Did you mention unemployment last week?
I ticked up. I don't recall.
Yeah. So unemployment ticked up to 4.6 with the job numbers. The job numbers actually were a little bit better than anticipated, but I think it's the all the federal employees that were flooding the market. Right. I think that padded the unemployment in the past few years. Right. They've been coming off the books. So
think about that. That's a net savings to taxpayers.
Oh, huge.
Right. Yeah. Huge. So if there's unemployment that you want, it's bureaucracy unemployment increasing that you want.
Run it more efficiently instead of just all the spending.
Exactly.
But the most recent inflation data, the CPI that came out, again, it's impacted a little bit because we had the government shutdown. But the November numbers came down to 2.7%, so down from 3%, lower than anticipated, which is great. Core CPI, which is this consumer price index, the main inflation. Core takes out food and energy, which is more volatile. Feds like to look at these numbers more so than just the headline CPI or the headline inflation, which involves everything out there. 2.6%, also down 3%. So when you're looking at the trend, it's been coming down. These most recent numbers are softer than anticipated, which is great news because we're going in the right direction. It's not yet to the 2% like the Fed wants, but we're going in the right direction. There are some pundits out there saying like, oh, they're skeptical about the numbers because the government shut down. It's a little noisy. We don't have all the data, so on and so forth. But the data that we do have, and who knows, BLS, I wouldn't be surprised they revise it
once again.
Yeah. But these are in the right direction, the direction that we want them to be, and where they're going. The key components that is contributing to what John was talking about earlier of what's really helping out the consumer here. Shelter and housing costs have come down. Food.
Well, Lennar is lowering their production home prices.
Their stocks
27%.
Yeah.
And Lennar is one of the biggest builders, if not the biggest builder in the country. And I mean, again, that's a major, people have been waiting. Oh, I'm waiting for interest rates to go down. I'm waiting for home prices to go down.
Right.
Well, guess what? Home prices are down. They're even down. Well, maybe not in the very specialty, real estate bubble areas like a beachfront home
or Bay Area,
or something like that. But overall, where most Americans can afford to live, all home prices are down, and rates, as far as a 30-year mortgage, dipped into the fives. So
high fives,
which is fantastic.
Yeah. And a lot of these new home builders I've seen, they're coming out with a lot of incentives, either helping to buy the rate down as an incentive or adding, more features and additions to the home without any cost, building in. So that's good news that Lennar's bringing their prices down. Their stock has been hit. The industry, the housing industry overall has when we're looking at the different stocks and indices and ETFs that measure housing and companies such as Lennar or KB Home or what have you, they've all started coming down primarily because of interest rates have been high for such a long period of time. But specific areas like food, shelter, housing costs, groceries, medicine.
Well, you look at eggs,
gas, airfare, car rentals,
eggs,
hotels,
80%. They spiked like toilet paper did. Pandemic.
Yeah, but eggs had that
bird flu
thing, so that's kind of an outlier.
But eggs and milk and dairy and all those things have come.
But airfare, gas, and look, I just came back from a vacation.
Yeah,
airports.
Yeah, you're tanner. You're more tan than normal.
The airlines were packed. The airports were busy. Hotels were busy. So people are plugging along. Economy is staying pretty resilient. I did sit through a timeshare thing, and that was a very interesting.
Right.
Oh, I mean,
yeah,
ridiculous.
Yeah.
I didn't buy. There's no way. But I sat there and just threw math at them, and they didn't like me at all.
Yeah.
And my wife said, "I'm never doing that with you again." It was totally embarrassing. I'm like, "What do you want me to do? I'm just stating facts."
Yeah, exactly. Let me get this straight. Yeah. Right.
So, but all of that came down, which is good, and that all helps. Like John was saying earlier, helps our pocketbook, helps us to free up a little bit more cash flow. And the big thing is, hopefully, they figure this out and both sides can agree on this healthcare front, costs of healthcare, because that's huge. And the number one thing that I've had already a couple clients that I've talked to, one of them recently laid off and 60 years old, was planning on retiring at 62, and now is debating, does he go back to corporate America and get a full-time job, or can he go back and do some sort of part-time job that he can enjoy and be basically semi-retired? And the number one thing that came up, well, I have healthcare. Yeah. And how much is that going to cost for my family?
Exactly.
Right. And they still have a minor living at home. And, that's a big bill to pay. And so, how do I bridge that gap for 5 years is basically the question.
Exactly right.
And that's what we do. And this is what we do. That particular client has a plan with us. And so we go into their live plan. And now things have changed because an event changed in their life, and we go in and it's fluid and create another scenario and say, let's say you retire outright, right? Let's say you get a part-time job. Let's say you go back to work. What are the outcomes? And the reality of it is they can actually retire now if they wanted to, based off of their lifestyle and kind of the expenses that they have and the retirement spend that they're looking to have. And if he has a part-time job, they'll still be fine, even with the addition of healthcare costs and the COBRA that they would have to float for so many months, so on and so forth. But that's why it's important to have a plan, right? Because these things happen and it's out of the blue. You don't know, right? This was totally unexpected event for this client. But we were able to, instead of scrambling around like, oh no, what am I going to do? How do I, it was a stressful event for them and their household, but their call to me was, no, I'm looking at your plan right now. And literally in 5 minutes, I rework some numbers, create a different scenario and say, you guys are going to be just fine.
I'm realizing that how much easier it is to do our radio show
tell me about
with
it.
two people. It'd been probably close to 2 years. Now you had done one without me.
Right. I actually found that I talk a lot more. I have to cut myself off. Funny enough.
Right.
I don't know why.
Yeah.
But I end up going, I end up looking at the time and it's like, okay, I gotta wrap this up. But I'm so used to, and this is much easier, the back and forth. But
and it just tells you, this sounds silly, but two heads are better than one, quite frankly. And it really is true, especially when it comes to, what we're talking about today. And again, you're doing a great recap of really the point and the goal for my call, or not call, but show last week was how important it is that your plan is a living, breathing, regularly revisited document, and that the implementation and, the effort to help you achieve your needs, wants, and wishes are a focus of your relationship with your advisory team and your advisory firm. And so often people, they do a plan as a box to check, right?
Right.
I got a financial, you're supposed to have a financial plan. I've got one. Check. You're supposed to have, a trust. I've got one. Check. Whatever the case may be.
And then
it's never looked at
like
again.
Put in a box collecting dust.
Yeah. And I would say that's probably the number one area where we're different is we don't look at a financial plan and your portfolio and your trust and estate and legacy as a box to check that I did the consultation, I did the plan, I did the trust, I did this, that, or the other.
Nor do we look at it as an addition to or something extra that we have to do. It's just part of a comprehensive approach with managing your assets, but also having a plan so everything is working congruently.
So, if you have done a plan and you've gone check, you've done it yourself or an advisory firm did it for you a number of years ago, it is absolutely time. And there isn't a better time than the end of the year or the beginning of the year to take a look at what you've planned for. Are you on track? Look at your portfolio. Did it do, well the last 3 years, especially this year? Is it set up, or are you just gambling on that? Hey, what was great this year, i.e. like NVIDIA or the Mag 7, or most of what drove the returns this year, are you just going to be in those same things next year, hoping for the same result? It's crucial to set yourself up for what is happening. And we follow the market. We follow the news. We follow information. We follow research. We follow guidance. And we tie it all back into what we helped you create to accomplish your goals and objectives. So give us a call at 916-967-3500 to arrange your no obligation consultation. And stay tuned. You're listening to the Wise Money Guys, John Scambray and Giuseppe Visconti. We'll be right back. Welcome back to the Wise Money Guys radio show. I'm your co-host, John Scambray. I'm here with my partner extraordinaire,
Giuseppe Visconti.
Did I mention we're certified portfolio managers?
You did in the first episode.
I did? Okay.
Yeah. But we're more than that. We have combined 50 years of experience.
Oh, that's true.
I have my master's
in economics and finance
and a charter retirement planning counselor designation.
Yep.
And what else? How much do you bench?
Not as much as I used to. Now doing dumbbells of 20 and 35 pounds is what I work out with.
I was good, but I've been like my back's out of commission. So I haven't done anything for a month. I don't even know what I can do.
So I literally, it's funny you bring that up because I just picked up the dumbbells for a first time in a long time since having my.
You and the dumbbells had a reunion? It's like high school. Yeah. It's like your 30th high school reunion.
Yeah. And so after I just did some military with them, and I did some curls, and I did some, rows
for your back.
Yeah. For my back. So, I was basically working on shoulders and back and biceps a little bit. Yeah. And, when I got into the shower to wash my hair, I had to literally throw my arm up on my head to be able to wash my head because I just don't have the muscle endurance, so anyway, all right. Another,
but that is important. We talk about finances all the time and finding ways to put your plan together and your portfolio, managing your portfolio to have longevity, right? How do you've worked so hard to save all this money, and now you want to go out there and achieve your financial goals, whether it's retirement or anything else for yourself or your family. You want to make your money last, right? That's the number one key thing, is that because you can't replace it. You're not going back out there and starting a new business or going back out there in corporate America and getting a job to replace what you might have lost because you took too much risk, right? And that's the same with your health, because the bottom line is, and what we've learned and what I've learned, especially this year, unfortunately, with just family, events that have taken place, unfortunate events that have taken place, is that without your health,
there's nothing.
It doesn't matter how much money you have.
Yeah.
It doesn't matter on all this other stuff. It's just throw it out the window, right? Because then all these goals that you had, and I've heard it before, I have my couple buddies that are firefighters, and one of them was looking at it and saying, I'm not going to do this forever, because he's seen a couple, of his colleagues retire. And then literally 2-3 years later, for things that they've been exposed with, they get cancer, and then they can't even enjoy themselves, and they're just fighting for their lives in retirement. So it's having a good balance, right? And it's that, where you started this company, Health and Wealth Advisory, right? Not that we're doctors or not that we're nurses or anything, but it's a key component to really pay attention to and overall balance. And that also makes sense of having balance in your financial picture too, when you're just focusing on the financial picture, right? You can't just go after the gusto and say, I'm just going to do max 7 and try and get these big gains with my money. And then you're, omitting everything else out there. And then you have one big down year, and now you're stressed out because you took too much risk, right? And so it's the same thing. Risk is on all kinds of different sides. Are you risking your health? And therefore now you're risking your longevity of your health for yourself, and then the money doesn't matter, and your family, and the money doesn't matter. Are you also taking too much risk with your assets, or taking risk that you don't have a plan, right? That you just have your portfolio doing whatever it's doing, but it's not tied to a plan to say, is it on track? Are you taking too much risk? Are you taking too little risk, right? And you're trying to create balance.
Yeah, I would again say that our uniqueness is being able to potentially, because it doesn't happen all the time, but in most cases, we find that people have embedded expenses in their funds and things that we're able to reduce the cost of your investments, and then really focus on, okay, how are we going to get you the net return that you need to accomplish what you put in the plan that we worked on together, to get you to the needs that you have, potentially the wants and wishes that you have, without, people think that, to get a 6, 7, 8% return, if that's what you need to accomplish all of your goals and objectives, that the only way you can get that is in some sort of, risky stock investment. And that's just not the case. And then there's
not right now.
And there's different levels of risk when it comes to buying a particular stock or a particular fund. They're not all created equally when we look at the different measurements of risk that the investment has demonstrated. over a period of time. And there is great income investments, dividend paying, interest paying investments that haven't been this high, quite frankly, at least in my career that I know of. I mean, I got in right at the beginning of the 90s, where we just came off of, inflation numbers that,
it was a recession in the early 90s,
right? That were unbelievable, because of what happened with the inflation and interest rates in the 80s. People forget that.
But we were at a surplus, right?
We were definitely.
That was during the Clinton era.
We had a budget surplus.
We had the war going on,
and that's really helped to shore up the dollar destruction that caused inflation. But where I was going, overall, is that the goal of your relationship with your advisor should be that they understand, first of all, the basic things that you're trying to do with your money and your legacy, and then figuring out how on an ongoing basis to put you in a portfolio that gets you there with, as you said, without taking the risk that you just don't need, or why would you do it? Because you're not going to go back to work at 70 years old, 65 years old.
It's like you going back to deciding that you want to do motocross, dirt biking, like you did when you were younger.
Yeah, exactly. And now, now I'm paying the price. But nevertheless, it's so important to align your risk with your station, your current station in life. If you're working and generating, a great income and take home pay, and you're paying down your debts and you're accumulating wealth, you have time when you're in your 30s, 40s, and 50s to literally, overcome a bad market like 2022 or the beginning of 25, or the wild swings from the pandemic in 2020, or the market downturn in 2018.
From 2020 till now, there's been a lot of wild swings.
I mean, insane. And so many times people and even advisors, sadly, that are woefully underskilled, woefully inexperienced,
or they just don't put the time in. I mean, look, right. I was on vacation.
They buy high and sell low.
I was on vacation, and what did I text you? What was I looking at?
Yeah, you were looking at, market information and investments.
No, more so than that. I was tracking our core equity portfolio,
core equity fund,
and comparing it to
the S&P,
500, and how it's done in the last month, the last 3 months, the last year to date, and the last year, right? And the amount of work that we put into that to try and be different and not just be a cookie cutter and throw you in, like you said, like a mutual fund, right? And that makes the difference, right? And if it's not making the difference, we're diving in and saying, what do we need to do better, or how do we need to shift or change things? But on a 1 month, 3 month, 1 month, not the 3 month, but the year to date, and also the 1 year trailing, our core equity portfolio has outpaced the S&P 500. Not that we've built that to do that, because primarily the focus is income first, growth second, where the S&P 500 is just pure growth essentially. And that's with paying an average about 3.2 to 3.3% in dividend yield, overall average of the overall portfolio. And it's outpaced the S&P 500. And the biggest
by a large margin, though.
But the bigger thing is this last month, where we've had some volatility and the markets haven't done so well. The S&P 500 was down, I think like 0.25%, and our core portfolio in that same period of time was up actually a little over 1%.
Yeah. So, for us, the point is, never stops. When you work with a big bank or a big brokerage firm like Morgan or Merrill or one of those, when Friday at 1:00 comes, the people responsible for your money and account, they go home and they don't think about you and what's going on again till maybe Monday morning, if you're lucky. Whereas I do more studying of what's going on and reading and researching about what is going on when I have downtime, when the market's not open. And we're always, available for our clients, 7 days a week. I mean, there's no, hey, I'm Monday through Friday. And if you need something, you can't get us to do something for you or talk about something. It's whenever our clients need us, we're available for them. And I think that's another very important thing in your advisory firm, is that the access and the availability and the response time to whatever it is you need is, right away. So we got to, wow. We got to go to our last break. You're listening to the Wise Money Guys, John Scamray and Giuseppe Viscani. We'll be right back. Welcome back to the Wise Money Guys radio show. I'm your co-host, John Scamray. I'm here with my partner, Giuseppe Viscani. And what we're going to talk about in this last few minutes here is our forecast and forecasts that we're looking into for 2026.
And the major investment banks and their forecast for 2026.
And then still talk a little bit about some of the things that happened and the data that we really like to look at because of its effects on your investments and your portfolios in 2025. But I did want to mention one thing before you finished going through your bullet points and looking at your notes here, is that I don't know if you saw the address by the president to the nation.
No, I was on a plane.
Well, there was one really cool thing that I'm just kind of dumbfounded, and maybe it's been done in the past. Maybe it was done in World War II or the Vietnam War, or the Korean War, or the Gulf War, or things, previously. But one of the things that the president rolled out that I think is just so important that we forget about our military heroes is a warrior dividend.
Oh, I've heard that. Yeah,
of $1,776 for 1,400,000 plus military members.
Right.
And could you imagine, first of all, they get paid nothing.
Right.
And I just thought it was just awesome. I mean, of course I know.
I think it's great. Playing devil's advocate, and you're probably not going to like this, is it just adds to the spending.
Yeah, but
I think they should revamp, because you just said the key thing, they're underpaid.
Yeah.
I think they should revamp and really take a look at that.
Yeah, I think all of our emergency workers, our military workers, they're way underpaid. I think we focus so much on education that,
teachers are underpaid too.
They're only underpaid not because of funding or spending in every format. It's because the money doesn't make it into a meritocracy system of finding the best teachers. So you have many teachers that get paid that, let's face it, their performance isn't great,
but they're locked in, they're protected, they got tenureship.
Exactly. Whereas the rest of the public, who works gets paid on performance, right? If we don't perform,
we're out.
We lose clients,
or a business shuts down,
and when you're so I don't think the teachers need more funding,
but there needs to be
more money that goes to awarding increased, compensation to teachers that have better performance than other teachers. And so, again, whether it's teachers, the military, emergency workers, especially nurses and the like. I just liked that
nurses get paid, at least in California. I don't know about the rest of but nurses and doctors definitely get paid.
Yeah, as they should.
Paid well.
But
public employees, such as, cops, right? The police, law enforcement, military.
But it was still very, very cool that,
good timing with the holidays coming up,
right? That finally, beyond just nurses, doctors, teachers, fire, police, that is so important and crucial that we support and love helping as clients, by the way, that also current military personnel are going to get a nice, or at least are being thought about, to get some of this money that goes out it goes out in subsidy to every important industry or career. But often the military,
it's like a little Christmas bonus.
Yep. Yeah, right? Exactly.
It's like private sector Christmas bonus.
I got us off on a tangent, but I thought that was, pretty amazing.
To that note, what that does is it'll provide maybe hopefully a little bit more discretionary income and therefore discretionary spending, right? Which will help out the economy, towards the end of this year, or at least during the Christmas holiday. The good news with this inflation data that's come out that we didn't get to, I don't believe we did, is wages have been increasing, and they've been increasing. The hourly earnings have increased by 3.5% year over year. Why is that important? Because that's greater than where inflation has been growing year over year, and that's what we want. We want wages to increase more so than inflation, right? So you have real wages, right, that is actually keeping up and superseding inflation. You're actually able to go out there and have a meaningful income to be able to have an increase, right? You can buy more, you can afford more, you can get that house, so on and so forth. So that's very important. That's important for the economy. And that's what we like to see, right? And not so much the handouts.
Yep. But in fact, we go over this a lot and spend some time on this particular, threat to an economy and to going into a recession is unemployment and wages. And so the fact is that based on where we're at now, unemployment less than the 5%, which there's, as far as I know, we haven't gone into a recession when unemployment's been below 5. And when you see wages that are increasing at a faster clip than inflation, you can't have a recession. I mean, I'm sure there's something.
Well, don't jinx it, John.
Yeah, right. I'm sure there's something that our politicians could blow up to make this that not be the case. But certainly historically, when you have wages outpacing inflation is basically in check.
Continue.
You have unemployment still at full employment. I mean, you typically have a good economy. So our outlook, overall for 2026, and I said it last weekend, is we believe 2026 is going to be a good one. However, and then you can go into the forecasts of, the different indices and what they may go up to and what percent that is. But there's still the government shutdown, the budgetary issues going on, tariff policies where, in any given moment, there could be a story about China or Canada or
I think China's
a major trading partner.
Trading partners, I'm not too concerned. The only ones really that I'm more concerned on is China.
Yeah.
That one has the biggest impact. If you go back and look at all the, related and trade related talks, China has had the biggest when it comes to China and it hits ahead between us and China, that usually has the biggest impact on the stock market. Everything else, not as much.
And I also think that the market and as far as where you make money in stocks is going to broaden. I think it'll be less about the Mag 7 in 2026.
You need to be more choosy.
It'll be more about, what I like to say is an indirect way to make money on the fourth industrial revolution is that you've got to be looking at certain types of energy plays that will be powering data centers. You got to look at, certain software plays, certain manufacturing.
Well, and it could be something not even related to that. I mean, we had Warner Brothers just put into one of our growth portfolios.
Yep.
Not that long ago. I think it was 1 month ago, and it's up double digits.
Yeah.
Warner Brothers.
Yeah. Well,
have you ever thought of Warner Brothers?
No, but that's the thing. I mean, there's so many companies that are great companies that pay a dividend. I mean,
unless Warner Brothers came out and said something about AI.
Right. They're in important sectors and industries. And I think we're going to see a broadening out of more companies that are going to have good, from high single digit to low double digit, growth rates. And then if you couple that with the dividends that they pay. For example, Owens Corning, I think, was just a forgotten company, and that could have a very good year. It's way off of its highs. And it's those kind of companies like that I think could have a really good year. But let's just roll out, the rest of your bullet points. And
yeah, real quick, because we're out of time here. But the 2026 major forecast from all the major investment banks, from Bank of America to Deutsche Bank, JP Morgan, Morgan Stanley, varies pretty widely, anywhere from where they think S&P 500 is going to finish, anywhere from 7,100 to 8,000. So that's about 3% from where we're at right now to 16% next year. But as we all know, they come out at least on a quarterly basis or even more frequently and revise them. And so we'll keep track of that. But other than that, it's been great talking with you. I hope everybody has a great weekend and a Merry Christmas. Yeah.
Yep. You've been listening to John Scammery, Giuseppe Visconti, the Wise Money Guys. Have a wonderful Saturday. Bye, all.